In this video, we're covering everything about 401ks in 5 parts: what they actually are, employer matching, how they're taxed, withdrawal rules, and the mistakes that cost people the most. A 401k sounds like a fancier version of a savings account. It's not. And missing the difference between them can cost you real money over time. A savings account holds money you've already been taxed on, and any interest it earns gets taxed again, every single year. A 401k is different. It's a retirement account offered through your employer, and the money inside it grows without being taxed year after year. Skip understanding this difference, and you could end up keeping money in the wrong place for decades, missing out on years of tax-deferred growth you never get back. Your 401k grows 100%, tax-deferred, no annual tax on the growth until you withdraw it. Here's how it actually works in 4 parts. 1, it's offered through your employer, so you sign up through your workplace, not a bank. 2, you choose a percentage of every paycheck to contribute, and it moves in automatically before you ever see it. 3, that money gets invested inside the plan, usually in mutual funds you pick from a list your employer offers. And 4, for a traditional 401k, that contribution comes out before taxes, which actually lowers your taxable income today, on top of growing tax-deferred. That's the foundation. Next, we'll look at something that can make a 401k even more valuable: employer matching, and the money many people leave on the table without realizing it. Your employer might be offering you free money every single paycheck, and if you're not contributing enough to get all of it, you're leaving some of it behind. That free money is called an employer match. Many companies will match what you contribute, up to a certain percentage of your salary, commonly somewhere around 3 to 6%. But there's a catch. That matched money often isn't fully yours right away. It usually follows a vesting schedule, meaning you have to stay with the company a certain number of years before it's completely yours to keep. Contribute too little and you're turning down guaranteed money. Leave a job before you're vested, and some of what your employer put in could disappear entirely. If you're 60 to 63 in 2026, you can contribute up to $35,750 of your own money. Here's what to actually do with this. First, contribute at least enough to get your full employer match. Anything less is turning down free money. Next, check your plan's vesting schedule before you assume that matched money is fully yours. Then, if you're 50 or older in 2026, you can add an extra $8,000 on top of the standard $24,500 limit, bringing your total to $32,500. And finally, if you're between 60 and 63, a special super catch-up bumps that extra amount to $11,250 for a total of $35,750 you're allowed to put in yourself. Now that you know how much can go in, next, let's talk about what happens when that money comes out and what actually happens to it if you leave your job. Change jobs, and your 401k doesn't just disappear, but what you do with it in the next few weeks can cost you thousands if you get it wrong. Every dollar you put into a traditional 401k goes in before taxes, which is why it lowers your paycheck's taxable income today. But that tax bill doesn't disappear, it's just delayed. When you eventually withdraw the money in retirement, it's taxed as ordinary income, just like a paycheck. Handle a job change the wrong way, and you could trigger a tax bill and a penalty on money you were never supposed to touch yet. Money goes in pre-tax. Money comes out taxed as income. When you leave a job, you generally have 4 options for that 401k money. First, you can leave it with your old employer's plan, if they allow it. You can also roll it into your new employer's 401k, keeping everything in one place. Another option is to roll it into an IRA, which usually gives you more investment choices. And finally, you can just cash it out, which is almost always the worst option, since it's taxed as income and hit with a 10% penalty if you're under 59.5. You now know how the money's taxed and what to do with it if you change jobs. Last, let's cover what happens when you're ready to actually take it out, and the one mistake that costs retirees the most. There are 2 ages that matter most for your 401k. Get either one wrong, and it could cost you thousands. Take money out before age 59.5, and you'll generally owe a 10% early withdrawal penalty on top of regular income tax. The IRS built this in specifically to discourage you from touching the money before retirement. Get the timing wrong on either end of retirement, too early or too late. and the IRS takes a bigger cut than most people ever plan for. Here are 4 ways to work with these rules instead of against them. First is the rule of 55. If you leave your job in or after the year you turn 55, you may be able to withdraw from that employer's 401k penalty-free, even before 59 and a half. Next, hardship withdrawals exist for specific situations like certain medical expenses, though you'll generally still owe income tax. Also, a strategy called 72T lets you take a series of equal payments early without the penalty if it's set up correctly. And finally, once you're required to take RMDs at 73, a qualified charitable distribution lets you send that money straight to a charity, satisfying the RMD without it counting as taxable income. You now know the rules for getting money out. Last, let's cover the mistakes that cost 401k owners the most and how to avoid every one of them. There's a 401k mistake that can quietly cost you more than a quarter of your entire retirement balance, and most people have no idea they're making it. According to the U.S. Government Accountability Office, 41% of 401k participants don't even know they're paying fees at all. These aren't obvious one-time charges. They're small percentages taken every single year, quietly compounding against you for decades. A fee difference that looks tiny on paper can turn into 6 figures of lost retirement savings by the time you actually need the money. According to the U.S. Department of Labor, a 1% fee balance can shrink your retirement balance by 28%. Here are the 5 mistakes that cost 401k owners the most and how to avoid each one. First, not contributing enough to get your full employer match, which we covered earlier. That's turning down guaranteed money. Next, cashing out an old 401k when you change jobs instead of rolling it over, which triggers taxes and penalties on money you didn't have to touch. Also, never increasing your contribution rate as your income grows, which quietly caps your savings for years at a time. In addition, ignoring the fee disclosure your plan sends you every year, since that's the only place you'll actually see what you're paying. And finally, missing an RMD after age 73, which we covered in earlier, an honest mistake that still comes with a real penalty attached. Let's bring it all together. A 401k is a tax-advantaged retirement account offered through your employer. Contribute enough to get your full match. Understand your vesting schedule and contribution limits. Know how your money is taxed going in and coming out. Know your options if you change jobs. And know the ages that matter most, 59 and a half and 73, so you're never caught off guard. If this series helped make 401ks make sense, subscribe to Over 50 Finance. We break down everything from Social Security to Medicare to scams targeting people over 50 every week.